I actually just record from the beginning. Okay. Okay, it's recording now. So we'll do the question. Okay. So we're going to read this highlighted section over here, background and industry information, just so we have an idea of the company. So they say Healthy Limited Pty Ltd HLL is a company that retails pharmaceutical products, prescription and over-the-counter medication, beauty and personal care products. HLL has 30 stores across South Africa. The pharmaceutical products category is the largest contributor to total revenue. Profit margins on medication are, however, regulated by the single exit price system, which was implemented in 2004. According to the SEP system, medication cannot be sold for an amount other than the SEP. While dispensing pharmacists may charge a dispensing fee to supplement the SEP, the dispensing fee is also regulated by the Department of Health. The Department of Health and South African Pharmacy Council have issued a number of draft regulations, but there is currently uncertainty as to when these regulations will be implemented. Although HLL is a well-known and developed business, the South African retail sector has been experiencing the impacts of the country's tough economic conditions. These conditions, characterized by, amongst others, political uncertainty, increased fuel prices, unstable electricity supply, and depressed commodity markets, have had a negative impact on the economy. This has placed a large amount of financial pressure on consumers and is further exacerbated by the developing trade war between China and the US. The trade war could negatively impact foreign exchange and the cost of import pharmaceuticals into South Africa. Okay, background, generally the background, and specifically this one is going to help you with part A, which is the risk management and strategy question. The capital structure, we covered this capital structure question for the WAC. New strategies. This is also going to help you with that part A with strategies and risk management question. I want to have a look at this over here. So let's quickly look, let's read it and we'll look at the required. So here they say investment in IT infrastructure. Currently, HLL, so let me just restart it. Currently, HLL retail from their stores, so meaning they sell from their stores. The company's marketing team recently undertook research costing 500,000 Rand to ascertain whether customers would like the option to make purchases online. Based on the results of this research, HLL would like to provide their customers with the option of purchasing their products online, with the exception of prescription medication online. Okay, I don't know how I read that anyway. So, up until there, what you pick up? Anyone? Fakir, your name appears fierce in my face. So, anything what you pick up over there? Anything important for you? And don't, like, even if you make mistake, I don't care about mistakes. This is part of the learning. So give it a try.
Okay, so I think picked up that the investment amount 64 million.
No, before we go into the 64, I'm just talking about up until where I read, up until the anything that you picked up in that few lines. Okay, anything important, yes or no? I didn't hear you say.
I'm just picking prescription medication. Research cost 500,000.
What about
I
it?
can think of.
Okay, what about it? Why is it important to you?
Okay, so if it's a research and development, SARS gives you a deduction on that, of course, around 50%. And the Yeah,
So that
that's what I can pick up from.
fine. Ryan, your name appears next in my, what you call it, that I can see. Anything important for you? Same section, or you want to just further comment on what Fakir had to say?
Also, just the 500,000, the cost
What
of
about
the
it?
or what would I say, the 500,000, the costing of the research. We won't incur that if we don't go ahead with the investment
Okay.
in this thing. Yeah.
Ashita, anything your side? You want to add in anything else you pick up that is that's important in those few lines? Let me get all the names up.
Uh,
Here, let's see.
um,
Yeah, who's
maybe
speaking?
I Fakir.
Yeah.
So it looks like it could be something relating to a relevant cost, maybe, or differential costs.
Okay.
Because even if we don't find out what we need to, it's a cost that we already incurred, possibly.
Okay. Ashita, anything? Mahlatsi, Faid, Rebecca, Larato. Want to add anything? Don't be afraid to make mistakes. This is where we're going to learn. We're on the training ground now. That's where you must make the mistakes.
Oh yeah.
I think
Who's
it's a
speaking?
cash flow.
Who's speaking?
It's Mahlat.
Okay.
Yeah, so firstly, it's cash flow. And because it's a cost, I think then we're going to say it's an outflow.
Okay. So yeah. So
So that's
definitely,
what it
Okay.
definitely an outflow. It's a cost.
I pick
Okay.
up here that okay, it's Faid speaking.
Yeah.
So they're a retail store and they want to make a change to selling online.
Yeah. That's correct.
They're doing research to see if an online purchasing system will work to go in. And so basically that I think that is I don't know how to put it in words. So that is like the project that they're trying to see if it's
Yes.
worth it to go online or whether
Yes, that's
or
correct.
not.
So are you gonna treat it
That's
So are you gonna treat it 500,000?
that's gonna be your initial investment cost, I think.
Okay. So we're gonna read further. Then we're gonna conclude on. We're gonna read further. We're gonna conclude. So I'm gonna read again.
Um,
Currently,
sorry.
HL. Hey.
Oh, sorry, man. I think Swaki speaking. I
Yeah.
think I meant a sunk instead of a relevant to differential. It's a past cost.
Okay. Gonna come there now. So currently, HLL retail from the stores. The company's marketing team recently undertook research costing 500,000 Rand to determine whether customers would like the option to make purchases online. Based on the results of this research, HLL would like to provide their customers with the option of purchasing their products with the exception of prescription medication online. Okay, so why with that exception? They can't sell online prescription because the person needs to come in and show their thing. Okay, so I'm assuming that's the reason. So listen to the wording. Listen to the wording. The wording said they're going to perform research, and then based on that research, they will make a decision whether or not they're going to go ahead. So the research will be done, and then they're going to make the decision based on the research. So when they make the decision to either go ahead or not to go ahead, so in this case, they chose to go ahead, that research cost has already been incurred. So it's not a future cash flow, it is a past cash flow. and that is a sunk cost. A sunk cost should not be included in your capital budgeting cash flows. So listen to the wording. They're conducting research. Once they conduct a research, they will use the research to make a decision. So at the time of the decision, the research cost is sunk, because whether they go ahead or don't go ahead, the research cost has already been incurred. So like in this case, we are going ahead, we should not factor in the 500,000 Rand, because it's no longer relevant. It has already been incurred. It is a sunk cost. Any sunk cost, we ignore. Okay? Do you understand that? So it was important to have read that few lines correctly. Faid, Ryan, Mahlati, I think you answered. Any, do you understand that?
Yes.
Sasula Rato got it.
Yes.
Okay. Ashita, Rebecca. So when you set up your analysis, the research cost must not be included. What's important, you must leave a note at the bottom to say research cost has been excluded because it is sunk. Because they don't know whether you forgot to include it, whether you didn't know what to do with it, or you actually knew what you had to do with it. So therefore you must tell them what you are doing. Okay. So just keep that in mind. I just want to see if there's any. So I'm going to check. Okay, so let's move on. So in order to facilitate the online offering, HLL will need to make a capital investment of 64 million Rand. So that is the initial investment, 64 million Rand. An initial investment is an outflow, so it'll be inside of brackets. Any outflow is inside of brackets. Any inflow is any outflow is outflow is inside of brackets, and any outflow is outside of brackets, meaning no brackets. So payment for the infrastructure would need to be made on 31 March 2020, and it will be ready to be utilized on 1 April 2020. So effectively, we're going to work in a period of 31 March 2020, 31 March 2021, 31 March 2022, so forth. Okay. So here we have 2020, 2021, 2022, 2023, 2024. The company is planning on funding the project with a 5-year loan at a cost price of 15% per annum pre-tax. Okay. What's important with this? Who want to give it a try? Rebecca, Ashita? Anybody want to give this a try? What's important? Why am I not getting the chat up?
I think it's going to help us to calculate the NPV.
Okay, for what reason?
To know whether to go ahead or not with the investment.
You know what? Yeah. So, how are we going to use it to calculate the NPV? As what? I'm going to elaborate a bit further.
I don't know. I'm not
sure.
there.
Okay, so it's fine. We'll check that out. We'll talk to that now. Now they say, given the rapid rate of change within the IT space, HLL will only make use of the IT infrastructure for a 4-year period, after which they will invest in more updated infrastructure. Okay, so that is so now you know the project is a 4-year project. It's important to understand how long. Okay, so you're going to have a 4-year project. So important, the item will only last for 4 years, and then they will invest more in updated infrastructure. So then you will just start off with a new project again. Okay, you can start from scratch then in 4 years' time. So to say for tax purposes, the South African Revenue Services will allow an allowance on the IT structure to be claimed equally over 4 years. Okay, so you'll say 64 million divided by 4. So here they say the financial manager of HLL prepared the following capital budget for the investment in IT infrastructure. So you're already given it. You don't have to do it. I'm going to do it with you, but we're first going to answer this question, then we're going to do it from scratch, okay? But it'll be quick. So here you can see there's a capital investment. You expect that. It's negative 64 million. We're going to have to decide whether we're happy with that. Do we want it negative? Do we want it in year 0? Here is research costs minus 500 in year 0. We need to check whether we're happy with this. Gross profit, note 1, we'll have a look. And then it's year 1, year 2, year 3, year 4, and these are the amounts. Then we have finance costs, and they show how they calculate finance costs. 64 million times 15% times 72, meaning after tax, there's a deduction each year. Then we have wear and tear, 64 divided by 4, 16 million, 16 million, 16 million, 16 million, which makes sense because they said for tax purposes, South African Revenue Service will allow an allowance. And then they have a continuing value. A continuing value just means, this means that from year 4 onwards for the rest of the life until the end of time or up until the company comes to an end, the company will make the NPV for the remaining years from year 4 up until when the world comes to an end or when the company comes to an end, they're going to generate 169 million rand. You need to have a look whether this makes sense. Then they have total cash flows, which is the sum of all of that. Then we have a discount rate at the cost of debt, 10.8%, which is 15% multiplied by 0.72 after tax, and that gives us an NPV of 87 million. I can tell you now, the question's probably going to say you need to evaluate this. So we will have a look, but let's first read note number 1. Note 1 says, this represents the profit from additional sales arising from offering online shopping. The estimates are based on the research results and can be considered reasonable. So you can accept. So remember they said this results from the profit from additional sales. That is future differential. So it's right. We only want the differential. We don't want all the sales because all the sales will occur whether we have online or not. So we only want the profits from online, and they're telling us that it is that. And they're saying the estimates are reasonable. The only thing you have to trigger your mind, they use the word gross profit. Gross profit could include non-cash flow items. They never mention anything of non-cash flow. So you can assume this number is totally fine. Then they say you may assume that the above analysis is arithmetically correct. If they didn't assume that, then you have to physically add up to make sure that they added up correctly. In a lot of psych exams, they don't tell you this. And then a lot of students don't add up because they think it's obvious. So then that is actually a problem. So arithmetically mean you don't have to recalculate 64 times 15 times 0.72. Because in some exams, if they didn't mention number 2, then you had to recalculate this to make sure that it actually comes to 6912. Similarly, over here, they're telling it's 10.8, which is made up of 15.72. 15 times 0.72. You'd have to calculate that to make sure it actually comes to 10.8. Similarly, over here, they're adding up all of these numbers. You'd have to physically add them up to make sure it comes to that number, and then actually to do the discounting. But because they say you may assume that the whatever it is correct, you don't have to do those type of checks. Okay. Then they just say any corporate tax is 28%. The shareholders have a required return of 18%. The gross profit after tax for the period 2020 was 2229 and is expected to grow at a rate of 5%. This we had to use in the WAC question. This we also had to use in the WAC question. Okay, so let's have a look at the required. Remember, part A is that risk management question, strategy risk management. Part B, we did this calculation, and now we're doing part C. Part C says identify the errors made by the financial manager in his IT infrastructure capital budget. Briefly discuss why it is an error and explain what should have been done. Your answer should be presented in the following format. Identify the error, discuss the error, and then correct the error. Your inputs, you are not required to reperform the capital budgeting or any of its inputs. Okay, so you don't have to reperform. You just need to identify. Can you guys, I'm going to give you 10 minutes. It's 10 to 8. From 10 to 8 till 8 o'clock. Come up with any errors over here, and then you're going to share it with me. I'm going to give you 10 minutes. Should be enough. Tell me what are all the problems that you pick up in here using the 5 principles. Future differential cash flow. What is this now? Future differential cash flow after tax, opportunity costs, correct column timing of cash flows, and then do not mixing financing with investing. So those are the 5 principles. Applying that, all 5 principles will not necessarily be in here, but then just apply that and tell me what errors you have. I'm going to give you about 10 minutes, not more than 10 minutes, and then we're going to start from 8 and go through it. So I'm actually going to give you 5 minutes so we can take 5 minutes to discuss it, and then we can start at 8. Okay, so I'm going to put myself on silent, and I'm going to take my camera off, and you guys can take the 5 minutes to have a look. I'll put my mute off. Okay, guys, can wrap up now. We're gonna start soon or resume soon. So, what any areas that you have picked up, and then we will go through it, and then we will be then I'll tackle with it. So we're gonna use this now the next 5 minutes from now till 8 o'clock to hear your feedback on what areas did you guys pick up in the scenario or in the capital budgeting that the finance manager have provided, and then we will go through it. So who want to go first? Any takers? Anyone?
I think I'll go first.
Okay.
So research costs, obviously it's a past cost, so it shouldn't have been included there as an outflow. And then finance costs, because we don't take any finance costs into account. And then I'm not sure.
Okay.
Yeah.
Yeah. So actually, just give me a moment. So actually, one time open up the Excel so that we can one time put in the answers. So now open up Excel quickly. Okay, so if we use that format that they wanted, I just want to go fix that format quickly. So it was identify error. So identify error, discussion of error, correction of error. So identify error, identify error, correction of error, correction of error. What was the other one? You know, correction of error was over there. What was the other one? What was the middle one?
Discussion.
Discussion of error. Okay, so the first one we're saying is so the capital budgeting has been given. So the first one is research costs. That's the problem. Research costs. So what is the problem? It sunk. So you can just say sunk costs. Okay. Sunk costs. So the correction of error, remove from capital budgeting. From capital budgeting calc. So the research cost is a problem. And why is it a problem? Why should not be included? It should not be included because it is a sunk cost. Like we explained, the research costs have taken place, and only once the research cost has taken place, now they make the decision. And based on the research cost, they're deciding to go ahead. But remember that is whether they go ahead or not go ahead, the costs have already been incurred. So therefore, we do not take it into account. Then we had, let me just see what was someone sent a message. So let's see who's put in the chat something. Okay. And then we're going to have finance costs. So with finance costs, why do we not include it? So discussion, finance costs should not be included. Should not be included because why? Because we do not mix financing with investing cash flows. More importantly, so there's generally debate regarding this. Some textbooks have different debates on this issue. So the more important aspect is financing costs is included in the discount rate. Okay, therefore should be excluded to avoid double counting. So any of those two reasons. So what you're going to do, remove from capital budgeting calc. Okay, so remove from capital budgeting calc. Any question at that point? Anybody have a question at this point in time? So far we've identified two errors. The research cost is a sunk cost, so therefore it should not be in the capital budgeting question. Finance cost should not be in the cash flow section. The reason being is it's included in the discount rate. And if we leave it in there, we're going to be double counting finance costs. Anyone else? Faid, you after Fakir. So I'm just going to ask you, did you identify anything else? Whoever want to is not going to...
No, I didn't.
You didn't identify anything else. Okay. So like Ashita, I know you like to send in the chat. If you have anything, then say. If you don't have anything, you can say there's nothing from your side. Rebecca already responded. She also had something with something like with Fakir, Mahlatsi, Larato, Ryan. Did you pick up anything?
Nothing specifically other than the two, but just what do we do? Do we leave WNT as is, or does that go in the tax section, or how do we deal with that part?
How do you want to deal with it?
I'm not sure if the question is correct. I'm not sure. That's what I'm asking.
Correct. So Ashita picked up the continuing value. The project is only a 4-year project. So you can't have a continuing value. By having a continuing value, we're assuming that the project's going to go on forever and ever and ever. There can be that argument. That you should have it in there. But generally, when you have a project for 4 years, it comes to an end and then you reevaluate again after that. So this is a touch and go one, right? But I would say the continuing value should not be in there because the project is only a 4-year project. Okay, so identification, continuing value. Should not be, the project is only 4 years. Therefore, no continuing value. Okay, so that is important. So remove from capital budgeting. Okay. Larato, anything else? Mahlatsi, you pick up anything else? 2 more minutes and I'm going to go through it. If you didn't, then you can just tell me, then I'll continue.
Nothing.
Nothing. Okay. So let's go through it. Okay. So you must go line for line. You only identify the errors, but you go line for line. Capital investment, they have a negative 64 million under year 0. We're happy with that. Why? The cost is 64 million. It is an outflow, so it should be negative. And the cost you do incur at the beginning of the period, of the investment period, and therefore we put it into year 0. Okay. Research costs, we discussed, it is a sunk cost, so therefore we have to remove it. Gross profit based on this, on what gave in note number 1, this is totally fine, so we can ignore it. Finance costs should not be included. Why? Finance costs is a financing cash flow. We do not mix investments with financing. Secondly, the finance cost is included in the discount rate. So by including the finance cost over here, we'll be double counting. So therefore, we need to remove. This wear and tear, it's fine to have it like this, but the problem is twofold. Number one, they're assuming this is the only tax issue, which is not true. And secondly, this is where they're getting you. This is totally fine by having wear and tear separately. But the problem with this is you don't want wear and tear. You want tax on wear and tear. So this they needed to multiply by 28%. For this to be correct as is, it needed to be multiplied by 28%. Because SARS is not giving you, SARS is giving you a wear and tear as a deduction based on the tax rate. So you must still multiply by 28%. So remember, when you do your taxable income calculation, you're going to deduct wear and tear, but that's going to fall into your taxable income amount. Then how do you get the tax? You take taxable income multiplied by 28%. Okay, so that is the problem over there. It's fine by being there, but it needed to be at 28%. You're not getting the wear and tear as a reduction. You're getting 28% on the wear and tear. The second issue over here is they're assuming this is the only tax issue over here. This is not the only tax issue. There's other tax issues as well. So basically, the tax would be as follows. The way I do my tax calc is as follows. So if I must do my tax calc over here, tax calculation, I'm just going the long way. There's a quick answer to this one. Let me just take you the long route quickly. So we're going to have details. We're going to have year 0, year 1, year 2, year 3, year 4. So we have our 4-year periods. Now we go look at our capital budget in question. We can see there's capital investment. We say, is there a tax on this? The answer is yes. There is a tax on it. There is a tax consequence. The tax consequence comes through wear and tear. Then I go to my next line item and I see research costs. If this was correct, then I would have a tax deduction for each research cost, but this is not correct, so therefore I don't include it. Then I have gross profit. Gross profit is correct. There will be a tax on gross profit, and this is the one they missed. They never brought in gross profit. So there's a tax on gross profit. The amounts are, so for example, this is 64,123 divided by 4. So that is correct. So it is 16 million. It is a deduction, so it will be negative. They had a deduction, so that's fine. My gross profit, can someone just read out the number? I'll go with the first one, 31,600. So 31,600, what's here 2?
34,444.
34,444, okay.
Next one, 37,544.
Okay.
The last one is 40,547.
40,547. Okay.
Yeah.
So now I go to the next. Finance cost shouldn't be in there, so I ignore it. Wear and tear, I brought that in. So remember, we don't have this line item is totally fine, separate, but we just need to tell them that wear and tear shouldn't be the 16 million. It should be 28% of wear and tear. The continuing value, we're taking the view there shouldn't be a continuing value, or at least me and Ashita's taking that view, that there shouldn't be a continuing value because it's only a 4-year project. Okay, so that's all the cash flows. There's no other cash flows. So now I can do my tax calc. So this gives me taxable income. So this will give me taxable income. Which is equal to some but we're not interested in taxable income, we're interested in tax. But we need taxable income to get tax, so we're going to say tax at 28%. So we'll just say equal to that times 28%. So this is what they needed to do. Okay, they needed to take 28% of the amount. So basically, this line item that they have is totally fine, but it needs to be 28% of 16 million. Then you must say, we should also include a 28% on the gross profit. So that is what we're going to do. So we will note that over here. We and T, the we and T deduction, the V&T deduction should not be the full amount, rather should be 28%. 28% thereof. Okay, so thereof. So here it will be negative 16,123 times 28%. So that's basically it. Okay, then over here we will say tax on gross profit. There should be included a tax at 28% on each year's gross profit. So you'll just say 28% times gross profit. Okay, I'm not going to write all the separate numbers down. So that is basically how the tax calculation would be if you had to do it from start to finish, but they already did that part. It is correct, partially. They just said they needed to take 28% thereof. Then you must say they completely left out the tax on the gross profit. So we need to bring that in. Okay, so all of this so far is fine. We spoke about the continuing value, and that gives us our total cash flows. We're not going to change that. They didn't ask us to change that. Then we come over here. Anybody have a problem with this or be fine with that?
Can I ask where is the minus 4480 coming from?
The minus 4480
Under correction of error.
is coming. So it's a V&T 16 million times the 28%. So instead of having 16 million, it should have been 28% of 16 million, which is 4480. Do you follow that?
Okay, thank you.
Anyone have a problem? Are we fine with this?
Yes, fine.
You fine? Ashita, you fine? With that discount rate? Rebecca, you fine? Larato, Fakir, Ryan, Mahlatsi?
Fine.
Who was that? I didn't. Who was that? Mahlatsi, was that you?
Yes.
Okay. Rebecca, Larato, Ashita, are you fine? Not fine? Ryan, Fakir?
Yes, I'm fine.
Ryan, want to tell me why you're fine with it? Just quick reason.
because you actually explained it now into detail, the tax calculation part of the question.
Okay, but and the discount rate here?
The discount rate.
Yeah, so my question is, are you fine with this discount rate? Are we happy with this discount rate to discount future cash flows? That's my
Yes.
question.
No.
That's Fakir.
Yeah. I don't know how correct, but it said here that if they would give 10% of their earnings if they insure business with them, but the discounted rate for the loan is 10.8%. So isn't that higher than what your return is?
Where's the 10%?
Being on top here. Okay, now that's something else related. But I've never seen it. Yeah, I'm not sure
Okay.
on that right there.
So anybody have something on the discount rate? Ashita, Larato, Rebecca, Mahlati. Fa'id, when you said you were okay with it, you were talking about the tax or the discount rate?
Tax.
Oh, okay. So on the discount rate. So the question is, are you happy with that discount rate of 10.8%?
Just a quick question, Faiz, where are they getting that discount rate? Is that correct? Because it doesn't say, shouldn't that be the cost to financing?
So here's the discount rate. So they're getting the discount rate from this thing over here. Can you see on my screen? The company is planning on funding the project with a 5-year loan at a cost of 15% per annum. So they're saying the discount rate is 10.8%, which is the 15% of the loan, but because with interest is a tax deduction, so it's 15% times 0.72. So that's how they get the 10.8. So the question is that 10.8 correct? Yes or no? If yes, why? If no, why?
I would say no.
So, okay, Mahlati, I think that's you. You want
I think I don't remember correctly, but I think there's still something we need to do with the 10.8. But I forgot what exactly, but I know that we have to do something else to get a
Okay,
certain number.
okay.
Sorry, man, this is Ryan. Isn't that 15% only specifically on the financing of the investment? Shouldn't that discount rate be based on the WACC discounted rate?
Excellent, excellent. So this is a typical example, okay? So the the discount rate that you use, to discount a capital budgeting question is always the WACC, and it's not based on the specific form of finance. So you must always take note that the rate you use to discount a capital budgeting question is the weighted average cost of capital, okay, your WACC. And it's not based on the actual source of finance. The actual source of finance is this. But irrespective of that being the actual source of finance, the discount rate has to be the weighted average cost of capital. Take note whenever you get a question of this nature, take note of the discount rate. What did they use? Okay, they're gonna throw in the source of finance. The source of finance is the loan, but you don't use the source of finance to discount a capital budgeting project. You use the company's weighted average cost of capital. Please take note of that. The rationale behind it is as follows. A company will obtain a specific source of finance. However, a capital budgeting question is a long-term investment. Over the long period of time, over a long term, each company will ensure that the capital structure meets the target capital structure, which is what you use in WACC. So just keep that in mind. Over a long period of time, a company will ensure that the capital structure meets the target capital structure. And as a result, even irrespective of which source of finance they take out, you must always base an investment project on the weighted average cost of capital. Remember, that is the why of WACC. What is the importance of WACC? The importance of WACC is that WACC is used as the discount rate when you discount valuations, certain valuations, and when you discount long-term investment projects. So take note, in a question like this, they're always going to throw in the actual source of finance, but what you need to take is the weighted average cost of capital. They could have spun this question by saying this loan, this project is partly loan, partly equity, and then they take the weighting of that. You don't want the weighting of the actual source of finance. You want the weighting of the general source of finance of the company as a whole over a long period of time. So please be aware of that. So the correction of the error over here is, so the identification is the discount rate. So what's the problem? The discount rate is based on the actual source of finance. Source of finance being the loan. What's the correction? Okay, the discount rate should be based on WACC. Okay, so very, very important that the discount rate has to be your weighted average cost of capital. So that when you do a capital budgeting question, make sure when you read through each line item that you include, when you read through each line, that it meet the at least one or some lines will meet multiple, but at least that it meets. So for example, capital investment, it meets a future differential cash flow, it meets the timing, it meets after tax. How does it? So future differential cash flow, capital investment, that's why we're including it. Okay. The timing is important. We're putting it in year 0. We're taking an after-tax amount. How are we taking an after-tax amount? There's the 100%, and then here would be the wear and tear, would be the after-tax component. So just make sure each time you go through the lines that you can meet some of it. 5 principles. Remember, principle number 1, future differential cash flow always has to be met. And then don't forget the discount rate has to be the weighted average cost of capital. So that's basically what I wanted to cover. It may appear a simple question, but it's not a simple question because you really needed to know what is happening. If you knew what was happening, you could get 13 out of 13. But if you did not know what was happening, it was easy for a person to lose quite a bit of marks. But that's all from my side. Is there any question that you have? So we'll go through each of you. I'll start with Ashita. So Ashita, you're probably going to put in the chat. I just want 2 things from you. What did you learn? And number 1, what did you learn? And number 2, what do you still find confusing? So each of you can tell me that. But if you have, after you ask whatever specific questions you may have. So Maharati, do you want to ask something?
Do you want to ask? No, I don't have a question, but I can answer what you just said.
Okay.
I've learned something that I never knew all this time, the timing of cash flows, the way you explained it today. So I think that's the most important thing that I learned today that I was not aware of. And also answering the question in a different way, because in most of the cases we answer it as you have to do it from scratch. So this is a different way of answering it. Yeah, thank you.
Okay, so what we call it, we're going to cover something similar to this in valuations. When we come to valuations, then you're going to see whether you know valuations or not. That question is going to test you inside out, and then you're going to see whether you actually know valuations. After you leave that question, you're going to feel like a professor because you're going to learn so much. So that is why I like these type of questions, because it causes you to think as opposed to just doing. Faid, what did you learn? What, at least one thing you learned, and if there was one thing that is still confusing to you.
Okay, what I learned was now the tax table, I always used to struggle with that tax calculation, how to bring it into your capital budgeting question. What is confusing for me, I think still trying to identify the the different components, what is a sunk cost, what is a relevant cost to something like that, what to include. The timing I'm fine with, but was still confusing
What we
to
call it.
me. What was the last one?
So now that's just a good question. So that's fine. I'll try to look for a question that is challenging that you must maybe attempt. Ashita, are you going to do you want to speak or do you want to type out? Okay. Fakir.
I learned thing I had an issue with was the timing, basically the years and how to align that. So I learned that, and I also learned how to actually put everything together because I've got an idea of certain things, but only in like isolation. But if I put it together now, it makes more understanding.
Okay.
Anything challenging for me? Not really, not at this moment. So yeah, I can just apply going forward.
Okay. Like so in the one capital budgeting question, maybe attempt that. I think what is it? In that the free Zoom class that we ran, I think it was the Mac 3702 question. I think I don't know which
Yeah,
one.
it was that one. Yeah, I think it was the 2020 paper.
Yeah. So there's a nice one. You must use that as a test and then try to do. I'm gonna see for another one from a CTA, and then you can see if you can put it into practice. Okay, so let's see quickly, Ashita. Okay, so Larat actually picked up the effects of taxation. Okay. So Ashita in PVRR, yeah. So that fire principle is very key, eh? Okay, I'm gonna try to find some more questions. Send it to you guys by tomorrow. Yeah. Anything confusing for you, Rebecca? So yeah, so this financing and investing is actually a very touchy subject, but CFA agrees with it. The lecturer from UCT, a guru in financial management in the real world, he also agrees with it. I think there's been some kind of issue with the mixture of finance and investing, the way UNISA looks at it, and or at least the textbook that UNISA uses. So as a result, the way UNISA looks at it, but I think it's more got to do with leases. But that is the double counting. So if you read up CFA. Because when I came across what UCT did, now the UCT lecturer, like he's a guru in financial management from a real world perspective. And then when I read what the textbook did, because I did it the way UNISA did it, for a Mac 3702 question, I think like 3 years ago, 5 years ago, a totally different answer, but it was on a leases question for financial management. And then when I read their commentary, they took a completely different view. So I guess there is still difference of opinion. But like I said, the UCT lecturer, CFA, like I used the new CFA notes and I checked what they say. They also say do not mix financing with investing. Now CFA is global, so we should be what you call it. Okay, so a few of you still need some more questions, so we'll select some more questions. Okay, that was Ashita, Faid, Fakir, Mahlatsi went through, Rebecca, Ryan.
Nothing specific. Like everyone else is saying, doing more questions, especially with the tax calculation in a more bigger in a more bigger question, just to apply it, and then afterwards, I will see where the challenges is.
Yeah. Um,
But this is also a nice question because it's giving you the reason why we including it or excluding it,
Excluding it,
because
yes.
the reason is important also. Yeah.
So make sure before you, so you can do another question. I'll tell you which question to, you. I mean, you can do your own, but I'll also recommend a certain question. But make sure that I don't run through 20 questions and you don't compare. Make sure you can compare question that Mac 3702 with this one. So, for example, you want to see how the Mac 3702 fit the 5 criterias and so forth. Remember, it doesn't have to fit all 5, but at least some of them. Okay, so just take note. Lerato, anything from your side? Anything that you learned? Anything confusing? Nothing. Are we all good then? Okay. Yeah, so the tax on the cash flows. So the tax on cash flow is important. So for example, in this question, you need to know which line items will attract tax. So just make sure from your perspective, you know from a tax point of view, which line items attract tax. Okay. So for example, capital investment will attract tax through V&T. Sales, variable costs, fixed costs will attract tax as per normal, like you have a gross profit. If you had working capital does not attract tax. So you don't include working capital in your tax calculation. You must read carefully regarding if you have an opportunity cost, how opportunity costs will impact tax. Okay, so just take note of those stuff. I'm going to try to select a question that has a few line items and that will require you to do the tax, and then you must see if you can do the tax calculation. But anyway, guys, that's all from my side. If you don't have any other questions, you can call it you can leave, and we're all good. So I made a mistake now in terms of the recording. So we missed the recording for the explanation. Like the explanation is in the same explanation basically in that free capital budgeting question. Okay, but if you need something specific, I don't mind to do another recording. Just take note, next week we're not going to have a normal session. We're going to have what we're going to have. We're going to have 2 sessions per class. Okay, so Monday to Friday. So you guys must tell me if you're happy with it. You can respond in the chat group. But basically, my plan is Monday is a public holiday, so Monday 9 till 11, and then Monday evening again 6:30 till 8:30. We can cover one exam question paper for Mac. I'm not exam, test paper, test 1 paper, and then Tuesday and Wednesday is FAC 1. We're going to use 1 test paper, 20 marks, 20 marks. And then Thursday and Friday, FAC 2, 20 marks, 20 marks. Okay, so that is going to be our test prep for Mac 37, for test 1. Okay, for all of them. Anyway, guys, all the best. See you. Bye-bye.
Thank you.
Okay.
Thank you.